Good morning, everyone. Good morning. This is the Pill Method Club, and you are in the room. How to pay off mortgages in 7 years. And Jared, please kick it off today.
Hey, good morning. Happy Monday, everybody. This is going to be an amazing week. We're ending out 2021, going into 2022, giving you some really valuable information that's going to really help you create some generational wealth as well as save hundreds of thousands of dollars of interest cost over your life of your mortgage. So you're in the P.I.L.L method. If you're in Clubhouse, make sure you go ahead and click that greenhouse at the top and follow the club. And when you follow the club, go ahead and read the about description. I'll give you a preview into what the P.I.L.L method is and what kind of information you'll be getting out of today's session. Once you read that, I would love for you to go ahead and click that plus sign and invite people in that could benefit from learning how to save almost 20 to 23 years on your mortgage. So take a mortgage that's 30 years and pay it off in 7 to 10 years. This also applies to student loans, credit card debt, car loan debt, any kind of debt. Don is going to show you how you can relook at your amortization chart and beat interest cost instead of only focusing on interest rate. And this is a very interactive room. So if you're in the Clubhouse, you make sure that you raise your hand and you come on stage as early as possible. We'll be running this room for 2 hours. It'll end at 10 a.m. Eastern time, and it never fails. The last 20 to 30 minutes, we'll have 5 to 6 hands raised, and we won't be able to get to you. So if you do have a question at any point, feel free to hop on stage. There are no bad questions. And if you're streaming on YouTube, Facebook, LinkedIn, or Twitter, make sure to ask questions in the comments, and my man Kirk will be scouring for those questions and we'll pause and recognize those as well. If you're on Clubhouse and you want to see examples live, we'll show you how to do that via the 10K card that's above us. So you can go to your laptop or iPad now, and you can go and type in ice10klive.com and go ahead and choose a streaming option that you like to use, whether it's YouTube, Twitter, Facebook, or LinkedIn. That way you'll be able to see Don's pearly whites as he goes through the amortization schedules, the calculators, and he breaks down how the P.I.L.L method will work on your amortization chart. So what we're going to do to kick it off is we're going to go through some moderator introductions. But before we do that, I would love for the man of the hour, Don, to introduce himself and to give you some insight into what you're going to be experiencing today. And as he does that, please make sure to click that plus sign, invite as many people into the room on Clubhouse. And if you're on the streaming platforms, click the share option, invite your friends and family. They're going to really be appreciative once they come in and get this information. So with that being said, Don, please go ahead and introduce yourself and tell people about the P.I.L.L method.
Good morning, everyone. My name is Don Daniel, and I'm the founder of P.I.L.L Method International, a better way to eliminate debt. And I say international because we're actually in 9 countries total right now and counting. So we're looking at going into South Africa next. And so listen, if you know anywhere around the world that that they have mortgages or loans, I can almost guarantee you that they use the same amortization schedule as here. And we can easily find that out. And if that's the case, the P.I.L.L method works in whatever country has a stable economy and uses this amortization schedule, and most of them do. So listen, folks, we want to be able to help out wherever we can. Now, how do we help? We tell people the truth about how lending actually works. What does that mean? Well, the interest rate you're quoted is not the interest rate you pay. For instance, a 3% loan for 30 years, you're going to pay back 51% of what you borrowed. $200,000 at 3% means the bank wants you to pay back $103,000 in interest over 30 years. On a $200,000 mortgage, the bank wants you to pay back $103,000 in interest on a 3% loan? How does that happen? We're not looking at that. All we're looking at is I got a payment I can afford and I got a great interest rate. And why is 3% a great interest rate? I don't know, because it's lower than 4? We don't pay attention to interest cost. We only pay attention to interest rate. And this is why we are here today, folks, because people are paying 75% more interest than they need to pay. It needs to stop. That money that is going to the bank needs to go into your investment accounts. When the bank receives it, they invest that money. Well, if you can get a loan and cut your interest cost, not your interest rate, but your interest cost by 75%, then you would be able to take that money and say, listen, I was able to acquire the same asset, my house, my rental property, my building, whatever it is, at 75% less because I'm not paying all that interest. And so I can acquire my property for less. Therefore, I can take that money that I would have spent on interest and purchase more property. Oh my goodness. This is what we're talking about today. I can't wait to get started and to jump into how we can cut interest costs, borrow money at a discount, and live well while we're doing it. Jared, I can't wait to get started. We need to go through our mod introductions because I've got something burning to get out there. Go ahead.
All right. So what we're going to do is do some quick 30-second moderator introductions, just a real quick what you do and how people can get a hold of you. And then Don is going to get into the information. And while we're going through the mod introductions, just would love for everybody to click that plus sign, invite people in the room, and also raise your hands and get on stage so you can be in the queue. Yeah, we're really excited for today's room. But the more interactive it is, the better. So we would love to hear your questions about refinance, your questions about your specific mortgage, because Don's time is not free outside of the app. But this little window that you have right here where he's pouring into you, this is free. So definitely take advantage of it. We had somebody yesterday that was about to put down a huge, upfront payment, and Don basically diverted them from doing that to save them multiple years on their mortgage, and their mind was blown. So hopefully we can have some more of those today. All right, so my name is Jared. I am really focused on the tech space and helping people break into tech, also help startups fund their tech business. So if you love to see my rooms or check me out on other platforms, you can catch me at jarrett10k.com. That's JARRETT10k.com. I'm going to pass it over to Credit Goddess next.
Thank you, Jared. Hey, everyone. But before I introduce myself, I'm going to get back to what I used to do. I used to just give shout outs to those in the audience, because if it wasn't for you guys, we wouldn't be here. I want to give a shout out to Renee down at the bottom, Renee Rowe, Maiwa Alude, if I pronounced that right, Lisa at the bottom, Lisa Mack, and King David. Thank you guys so much for being here. My name is Rosalora Lewis, also known as Credit Goddess. I am all things credit. I help improve my clients' credit so that way they can gain access to capital. So if you guys want to reach me, if you're looking for any personal credit, business credit needs, or even funding your startups or your current business, definitely reach out to me at creditgoddess10k.com. That's creditgoddess10k.com. Thank you.
Thank you, Credit Goddess. Appreciate you. So Tiffany let me know she's on a work call, but Tiffany is a very important part of our moderator crew. She helps us stream this on Wisdom and Twitch. She's an executive coach, advisor, mentor, leadership and organizational behavior, and she is focused on innovation and inclusive leadership. If you want to learn about all the different things she does in the financial sector, investments and logistics for 20 plus years, you can check her out at theyceo10k.com. Again, that's theyceo10k.com. All right, up next is Kirk.
Good morning, everybody. Good to be here. Excited for what we're about to dive into in this room.
And Don, I think you need to be off mute so we can hear Kirk.
Okay, go ahead.
Hey, good morning, everyone. Excited to be here. Excited for what we're about to get into in this room. And for my folks that are online watching right now, we want to encourage your comments. We are already responding to your comments in the chat here online, Facebook, YouTube, LinkedIn, and Twitter. We did have a question of whether or not we are live on Instagram, and I just wanted to respond to that person and say we are not on Instagram, at least not yet. But we may be looking to add that in the future. I know we are live on several other platforms through Tiffany's network as well. But I just wanted to welcome you this morning. My name is Kirk Nugent, also go by the Geek Speaker Preacher, and I am your live video strategist, live video coach. Check me out, kirk10klive.com.
Right, and up next we have our co-host that is with us day in and day out, and she's also going to be assisting you on different aspects of this room. Kenyatta, please let everybody know who you are and how they can get a hold of you.
Thank you. Good morning, family. I am Kenyatta. You can find me at kenyatta10k.com. And I am your real estate agent and broker from the state of Illinois and soon to be Georgia, as well as your financial service provider, helping you with all of your fix and flips, refinance, foreclosure on commercial properties, as well as business purpose loans. Right now, I ask that you go to ice10klive.com and choose how you want to view these examples. You don't want to miss it. And so we're streaming on Facebook, YouTube, Twitter, LinkedIn, and through Tiffany, which is the YCEO, we are on Wisdom and Twitch. So go ahead and make sure that you learn.
All right, last but not least, we have Coffee Brown.
Hey, welcome, rising, everybody. Super excited to be in the building. I am a certified master execution coach. I do everything humanly possible to teach people to go from expecting something without execution to executing to receive their expectations. So you can definitely connect with me on all social media platforms. Just click on my face and connect with me on those platforms, or go to coffee10k.com. That is KOFFE 10k.com.
All right, thank you for all the moderators for pulling up. If you're in the audience, make sure you click on all their faces, and I highly recommend giving them a follow. They curate amazing content in the hallway. So far, there's no questions, but Don, let's go ahead and give them an example of what you've done for your customers, and I'm sure that's going to stoke some hands raised and some folks coming on stage to ask about their personal situation. So I'm going to pass it back to you.
Thank you very much, sir. Listen, we're going to start out with remember in the days where we would have pop quizzes. So
man, that was so long ago, but yes, I remember that.
We're going to start out with a pop quiz. So we're going to put that on the screen right about now, folks. And here it is. And so we're going to go through. I'm going to go through each one of the questions, and then you can write down the answers or just, speak the answers out, however the way you want to do that. And then I'll go back and then we'll correct it. Okay. So here is the first question. All right. True or false? Is it possible for most families to pay off all of their student loan debt in 5 to 7 years without increasing their monthly budget? Okay. Is it possible for most families to pay off all of their student loan debt? Listen, they could be a lawyer, a doctor. It doesn't matter how much they have in student loans. It doesn't matter. Is it possible for them to pay it off in 5 to 7 years without increasing their budget? Number two, if you want to save money on a mortgage, now, if you're, listen, if you are online and if you're watching us live streaming, please tap in and type in your answers to this, because Kurt will get this and we can go over this. This is going to be very interesting on the answers that we get here. So make sure you go to ice10klive.com, click on the platform that you like best, and so that you can watch what we're doing here and answer these questions, and just put them in the chat section and comment this morning. Okay. So number two, if you want to save money on a mortgage, is it best to have a 30-year mortgage or a 15-year mortgage? All right. That's number two. Number three, true or false? When acquiring a new mortgage, you should try to make the largest down payment you can in order to save interest. I'll repeat that. Number 3, when acquiring a new mortgage, you should try to make the largest down payment you can in order to save interest. Number 4, now if any of these questions spark other questions, raise your hand. We'll bring you up to the stage if you're on Clubhouse, okay? If you have a $200,000 mortgage at 6%, and the bank is offering to refinance it at 4.5%, rolling in the closing cost, should I take that deal? Yes or no? If I have a $200,000 mortgage loan at 6%, and the bank is offering to refinance it at 4.5%, rolling in the closing costs, should we take it? Yes or no? Number 5, the average family pays out what percentage of their income, and that is their take-home pay, what percentage of their take-home pay in interest on their loans? And I'll ask it again. The average family pays out what percentage of their take-home pay in interest on their loans? Is it 10%? Is it 23%? Or is it 35% of their take-home pay that pays interest? Number 6, true or false? In most cases, you should use your debit card instead of your credit card to save money. Number 6, in most cases, you should use your debit card instead of your credit card to save money. And number 7, and the last one here, people who have perfect credit are routinely paying 100% to 300% interest on their loans. True or false? People who have perfect credit are routinely paying 100 to 300% interest on their loans. All right. Okay. So what we're going to do now is just go back over the answers, and then if you want to ask more questions, come up to the stage or type something in the comment section, and then we'll go over these things. Okay. True or false? Here's the answer to number 1. True or false? It is possible for most families to pay off their student loan debt in 5 to 7 years without increasing their monthly budget. The answer is true. 5 to 7 years is the average for paying off all student loans using the P.I.L.L method. Okay. And number 2, if you want to save money on a mortgage, is it best to have a 30-year mortgage or a 15-year mortgage? Well, it is best to have a 30-year mortgage if you want to save money. 30, listen, they even have 40-year mortgages. So if you can get a 30-year mortgage or a 40-year mortgage, jump on it with both feet. We'll show you how to pay both of those off in 7 to 9 years, even multiple mortgages. All right. By using interest cancellation, using the P.I.L.L method, you can cut your interest costs by 75% on these loans. Never, ever, 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 ever get a 15-year mortgage. Never do it. Okay. All right. Number 3, when acquiring a new mortgage, you should try, you should try to make the largest down payment you can in order to save interest. False. Never, ever, 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 ever put a large down payment on larger than you need to. Never put a large down payment on a mortgage or a car loan. Ever. Don't ever do it. And never pay cash for a car either. Never. Don't do it. Okay. We're going to show you how to borrow money at a reduced interest cost for your mortgage and your cars, so that you can borrow money at a discount and keep your money working in your investment instead. All right. So cash is not king in this society. I'm just trying. There are financial gurus out there. There are people who will tell you that cash is king, and we want to do everything cash. Absolutely not. And Credit Goddess can talk to you about that. All right. Cash is not king. A wise use of somebody else's money is what's happening today. In fact, I can prove that to you because banks are the biggest borrowers in town. Your bank borrows more money than anybody. They borrow our money. They make big money with our money by investing it and then pay us pennies on the dollar for the use of it. Well, why can't we do the same thing? We could do the same thing. We could borrow their money, get a big old benefit for using their money, and then pay them back in such a way that we pay them pennies on the dollar for the use of their money, a lot less than they were expecting, because now we know how to read an amortization schedule and we know how to defeat it. Because of the P.I.L.L method. Yes, 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 yes. So when acquiring a new mortgage, you should try to make the largest down payment. False. Boom. Don't do it. All right. If you have a $200,000 mortgage at 6% and the bank is offering to refinance at 4.5%, rolling in the closing costs, should I take it? In most cases, the answer is no. In most cases, the answer is no. In some cases, it could work out for you, depending on some other things. But in most cases, the answer is no, because the cost is too high. Why not take what you have? You take your mortgage that you have now, and using the P.I.L.L method, pay it off in 5 to 7 years. Here's what happens. Do you know the major reason people refinance? One of them is to get a lower payment. All right. And they think it's the interest rate that does it. Every 5 to 7 years, people refinance. So here's what really lowers the payment. When you take what you owe now, say you're into this loan 7 years. All right. And then after 7 years, you decide you want to refinance to get a lower interest rate. And now your payment drops by $200, $300, $400. Do you know what really drops the payment? Not the fact that you got a lower interest rate. That is not the major contributing factor. The major contributing factor is that you're taking your current balance on this loan and dividing it by a new 360 payments, a new 30-year loan. So folks, if you have a 30-year mortgage and you get a refinance after 7 years, you now have a 37-year mortgage. I'll let that sink in. Let that marinate for a minute. 30 years, 7 years in, then you decide, because the interest rates drop, because somebody said if you can lower your interest cost by 2 points or more, you should refinance. Somebody said that, and a lot of people are doing it because they're following that advice, and they're not thinking about the fact that they now have a 37-year mortgage. And do you know what they're going to do 5 to 7 years from now? They're going to do it again. Americans don't have 30-year mortgages. We have a string of 5 to 7 year mortgages until we die, because the average person refinances their loan every 5 to 7 years. They don't realize what they're doing, chasing an interest rate, extending the life of this loan until they're never able to pay it off. Oh my gosh. Okay, that's what we're into. All right, so now number 5. The average family pays out what percentage of their income in interest on their loans? 10%, 23%, 35%. Well, the answer is 35 to 39%. Jonathan Jones, go right ahead, brother. 35 to 39%. Okay, 39 to 35% is what that most families pay out of their current income, their take-home pay. Out of their take-home pay, they pay 35 to 39% of their take-home pay in just interest payments alone, if you add it all up. And I'm not talking about people who are struggling or who are financially irresponsible. I'm talking about people who make great money, pay all their bills on time, and are doing well financially. They still pay 35 to 39% of their take home pay on interest. Well, if they're doing so well with paying that much money, what if we could cut their interest cost by 75%? Ha! And then add that money to what they're doing as well. Oh my gosh. Interest siphons off our wealth and transfers it to someone else. Okay. And I had somebody challenge me that on that last night, and we'll talk about that. All right. And number 6, in most cases, you should use your debit card instead of your credit card to save money. Can I let you in on a little secret? My debit card is an emergency card. I only use credit cards because credit cards pay me to use them. My credit cards pay me to use them. I get points, I get cash back, I get all kinds of benefits for using credit cards. We're going to listen. It is possible. It is possible to use credit cards and get paid. My goodness, we should learn how to do that. You know what? Can I give you just a small trick? All right, just a small trick. Now, we had to buy some outdoor furniture. So we went to the outdoor furniture store, and the price tag was up there. So what I did was I said, listen, hold the furniture for me, and I'll pay for it on the 29th of the month, of the month with my credit card. Okay. And they did that. So why did I say I'll pay for it on the 29th? Because my closing date is on the 28th. They close my credit card on the 28th of the month. So when I went and charged that stuff on my credit card on the 29th, of let's say it was the 29th of June, that purchase did not show up on my July bill. It didn't show up until August, and I didn't have to pay it until the 22nd of August. Listen, I bought it in June, didn't have to pay for it in July, and listen, and then August was almost done before I paid for it, and I paid it all off, no interest. But who gets to keep the points? I do. And it gave me almost 2 months to do it. Listen, folks, you got to know what your payment date is and what your statement date or closing date is on these credit cards. You can do a lot. All right. Learning how to handle that money. Okay. Number seven, here we go. True or false? People who have perfect credit are routinely paying 100 to 300% interest on their loans. The reason why I say that, and it is true, the reason why I say that is because people with perfect credit, a lot of them are paying, are using this idea of refinancing, or they are doing consolidation loans using their mortgage. Okay, I'm going to give you an example of what happens when you use your mortgage to do a refinance and then pay. So they take that money, cash out, and pay off all of your high interest credit cards. Okay, so what we're going to do is put something else up on the screen. And while I'm putting that up on the screen, are there any questions or comments either on live stream or in our on Clubhouse? All right, while I'm setting up this new example. Go ahead, fellas.
Well, you're just killing us. You really are. Everybody that heard one thing, you're telling us something totally opposite. I have to go back into my prayer closet. A lot.
Miss Coffee, what do you mean by that? Come on.
I did one. Okay, go ahead. Sorry, go ahead.
Can you hear me?
Very, Barely.
Yeah. It's a little inaudible. I don't know if you have headphones in or.
Is it better now or no?
It's good enough. Go ahead.
It's better.
Okay. So yesterday my son and I were in a meeting and I was telling him, I said, yeah, I'm gonna go ahead and get me, a new vehicle, give you this one and snatch me a new one, a 2-year-old, and just go ahead and pay it out in cash. My son he's in the car industry. He said, Mom, you're a fool. And I said, excuse me? And he was saying what you were saying, and I told him, I said, that's not what we've been taught. And he was saying, do your research. And now, ironically, not even 12 hours later, you're literally saying the same thing he said, but you're defining it. And that's not what we've heard. We've heard for so long that, cash is where it's at. And now you're saying that those are myths. But can you talk a little bit more about the credit card situation? Because I want people to make sure they're clear on that and not let those cards get away from them. So how do you use those cards wisely when it comes to building up those assets through the credit card usage?
Miss Coffee Brown, that is an excellent question. And folks, this is how you use a credit card wisely. Credit cards are for people who have resources. They have money. Credit cards are for people who have money in the bank that can pay them off at any time. Credit cards are not for people who don't have resources. Okay? Here's what I mean. Never use your credit card because I don't have the money and I don't know where I'm going to get the money. That's not why you use your credit card. I use my credit card out of convenience because I can pay it off whenever I want. So I get the credit card and I'm using my credit card to get the points, to get the cash back. If you have a business card, there are a ton of perks with using your business platinum card. And you get 5 times the air miles. 5 times the points when you go on vacation or when you travel. Listen, you get discounts on your food. There's so many benefits you can get by using the card. And then because you have the cash on hand, you can pay the card off in 30 to 45 days, paying no interest. And then you get to keep all the points for free. There are people who are using their points to buy computers, to buy iPads, to buy flights, upgrade to,
Hotels.
Listen, hotels. You know what? I fly first class. And first class, because of COVID, first class isn't such a big deal anymore. Listen, I tell you what, if for me, for now, just to give you a little tip, go to the business section or the section right behind first class, okay? Because you get almost the same service as first class now because because of COVID, they're not treating you like they used to treat you. All right, so sit in that section behind first class. You still get to board earlier. The only thing that you don't get is the free luggage. But my point is, by using your points, you can upgrade to better seats and better boarding and better treatment using these points, and you get them for free. So, Miss Coffee Brown, is that what you're talking about? If you're talking, you're on mute.
God, I'm over here just gathering myself together.
So, folks, this is what we're talking about by learning how to use these financial tools to your benefit and not to your detriment. So, credit cards are for people who have resources, not for people who don't have resources. All right. So, remember that. Plus, our program keeps track of all of your credit cards and your payments. Therefore, we will not let you pay more interest on these cards than you need to. The program itself will guide you in paying off all of this debt and saving the maximum amount of interest possible. And if you use your credit card, here's what I use my credit card for. Okay. I use it to buy food. I use it to buy gasoline. I use it to pay for my cell phone. I use it to whatever I can use a check for, and that company accepts my credit card, I pay with a credit card instead of a check. Now, why would I do that? Because I want my cash working for me, making babies. When you use a debit card, whose money are you spending when you use a debit card? You're spending your own money. And because of a thing called opportunity cost, if you spend your money, you can't also invest the same money because you spent it. Okay. A farmer has seed and seed to plant and then harvest a crop. Well, folks, if you use your debit card, you are eating your seed. That's what I'm saying. Stop eating your seed. Plant your seed. Make that money make babies. Use your credit card instead, and then get the points or get the cash back, get paid, and then take the money that you would have paid for the food, the money that you would have paid for the gasoline, the money that you would have paid for your cell phone. You take that and pay the card off back to zero and keep all the points for free. Listen, folks, it's just a way of, it's just a better way of taking a look at these things. Okay. So any other questions? Coffee, any other comments?
So we have a question on the stage, and Kirk, I'm sure we have one in the simulcast, but I would love for Dolores, if we could just get to her first. Thank you so much for your patience. Dolores, what question do you have for Don today?
Well, I'm in the process of buying my home, and I close on January 31st. And it says I see your order, your head of your thing is pay your loan off, pay your thing off in 7 years. So how do I pay it off in 7 years?
Very good. So Dolores, it is the 7 years is an average. 7 to 9 years is our average. Some people actually pay it off faster than that, depending on their resources. Some people take maybe a little longer than that, maybe 10 to 12 years, but it's still better than 30. So this is an average. So so I will show you how that is done. Are you actually watching what we're doing online?
No.
Okay. So this is something that you probably want to see, Miss Dolores. Are you near a computer or iPad or tablet or something?
My phone.
Okay, so yeah, if you do that, then we won't be able to talk. But I'll try to explain it to you. If you try to watch it on your phone, we can't communicate, because by doing it on your phone, there's always a delay on what you see, and we can't communicate. So,
but don't fret, Dolores, because if you go to ice10k.com and you go to Facebook, you can watch previous recorded sessions. So you'll be able to actually see this at your leisure. Okay.
Right.
Okay.
So you can actually see this a little later. So tell us a little bit about your mortgage. I'm going to shift screens here. All right. And then we're going to put some information here about your new mortgage. Is that okay, Dolores?
Yes.
All right. So let's go ahead and put this on. There we go. And we're going to put that up on the screen for everybody else.
Yep. And while Don is putting it up on the screen, just a reminder for those that are new to the room, if you're close to an iPad or a laptop, you can go to ice10klive.com and then choose either YouTube, Facebook, Twitter, or LinkedIn to watch Don's example live on your screen. And so, yeah, we look forward to seeing you in there. And also make sure to click that plus sign and invite some people into the room, because Don's example that he's about to go through is going to be huge for people's new year. So definitely click that plus sign, invite as many people in the room. And if you're on a streaming platform, click the share option and share it to your friends in your friends list. All right, back to you, Don.
All right, listen. So folks, if everybody who's in here, we got 75 people in here now, let's invite at least 2 people. All right. And let's grow this to over 100. Okay. So here's what we're talking about, Dolores. Tell me, about how much is your mortgage going to be?
515.
515. Okay. Is that how much you borrowed, or is that what your payment is going to be?
My payment's gonna be 515.
How much did you borrow?
They gave me 70,000, but I'm gonna put 25 down.
You're going to put 25 down. Do you want to put 25 down?
Yes, I want to pay it off quick as I can.
Okay. So we're gonna show you two things today. Okay.
Okay.
Number one, never put a large down payment on a loan. Ever. All right. So you definitely want to see this. So the entire amount is how much? You said 75,000?
70,000.
70,000. Okay. So we put 70,000. Okay. And your interest rate is how much?
I think it's 3 point something.
Okay. Let's put 3.125. Okay. And 30-year loan?
15.
15-year loan. Okay. Is there any way you can get that changed?
I tried to do 10, but he said I couldn't do 10. I could do
Okay.
15.
You want to do a 30 and pay it off in 7.
Okay.
Okay. Because
And
see,
what do you say about 15-year mortgages done?
here's what's happening with a 15-year mortgage. All right. So if we have a 15-year mortgage, right? And I'm putting the numbers on right now. 15-year mortgage. Okay. Oh, okay. Let me change that. Okay. You said 70. You said 70,000.
Yes.
Okay. All right. 70,000 at 3.125. All right. And you're trying to get it down to 20, trying to put 25,000 down.
Yeah.
Okay. Something is not adding up here. Okay. So even if we did, so you're trying to have a loan for $45,000.
Yes.
Yeah, 45,000. All right, I'm putting 45,000 at 3.125. And okay, let me see, 180. Sorry, that was my fault. I put in the number of years and not the number of months. Okay, so 70,000. Let me do this, $70,000. Okay, all right, and that was my fault. 180 months. Okay, that payment is $487.63. Okay, 487.63. All right, that is for a 15-year mortgage. Do you know that if you had a 30-year mortgage, you could still pay the 487.63? You don't need permission to do that.
Yeah, he said that.
Okay, so if I get a 30-year, all right, if I do 360 payments, okay, 360 payments, then my payment is $299.86. See, what happens if we get a 15-year mortgage, number one, and things get a little tight, you're stuck with that larger payment. You can get the 30-year mortgage where your payment would be $299.86 and still make the 15-year payment if you wanted to. And if things get tight, you can drop back down to the $299.86. Does that make sense to you?
Yes.
Okay. All right. So here's the other thing we're talking about. Okay. So let's take a look at. We're gonna take a look at this at a 70,000 at $299.86 is the payment. All right, instead of the $500. Now, for the very first payment, $117.57 goes to principal. $182.29 goes to interest. That's payment number one. All right. Payment number two, $117.87. It only changes by 30 cents. $117.87 goes to principal, and $181.99 goes to interest. So if you wanted to, you could make the very first payment. That would, let's say it's January. You're paying your first payment in January. February's principal payment would be $117.87. You could actually pay that in in January as well, the 117.87. Knock out the interest payment on line 2, save $181.99, and your next mortgage payment for February will actually be on line 3 of your mortgage. Now, here is what you need to know to put all of this into perspective when you rewatch this. After 1 year, we're looking at cumulative principal and cumulative interest. After 1 year, by doing it the bank's way, you would pay down this loan by $1,431.21. That's how much goes to principal. How much would go to interest is $2,167.11 would go to interest in the first year. So now you're going to pay $1,431 towards your principal in 1 year. Here's the question. Do you have to pay it in 12 monthly installments? Or if you had the $1,431 up front, could you pay it all at one time if you had the money, if you wanted to? The answer is you could pay it all at once. That $1,431 could be paid in 1 month. You're paid down to line 12 on your amortization schedule in 1 month, knocking out 11 payments you never have to make by giving the bank the same amount of money they would recover from you in 12 months. You're going to pay it in 1. Just give me an example. Pay it in 1, and you're paid down to line 12 on your amortization schedule, not for $2,167 in interest, but only for $182.29 in interest. So, Dolores, when you rewatch this, what you want to do is give us a call. Go to ice10klive.com. As you can see it up here on our top. Click on that link. In that link, it says get a savings and earnings report. By clicking on that, you can put your information in now, and our team will work on a savings and earnings report for you, get you a consultation. You can know the month, day, and year you could be debt-free on this loan within usually a 7 to 9 year window by using a 30-year loan instead of a 15-year loan. Okay? So would you rather pay off this loan in 15 years or pay it off in 7? Ms. Dolores?
I want to pay it off like in at least 7 years. I don't want to do the 15.
Okay. Well, then if you don't want to do the 15, then don't. Let's not do it in 15.
Okay.
Let's not set ourselves up for failure. Let's get the regular mortgage, and we'll show you how to pay it off in a lot less time. We can plug in the numbers and then give you good advice on what steps to take to make sure that you pay it off when you want to. So go to ice10klive.com, click on the button that says get a savings and earnings report. We will do all the math for you, set up a consultation, and we can show you what your income can do to get you out of debt faster than 30 years and cheaper than the amount of interest that they want you to pay. How's that sound, Mr. Dolores?
Yes.
All right. Excellent. I'm glad this was helpful to you. Do you have any other questions?
No, that'll be all. Thank you so much.
You're so welcome. All right, folks. Anything else going on out there that we can tackle today?
Yeah, Kirk, anything from the chats?
Well, we had some folks who were very excited about the quiz, Don. I don't know if you caught some of those comments. One person said, I aced it. I've been trained well. They have been coming for a long time. But another person did come and say, this is the best program ever. Tammy on Facebook says this is the best program ever. And then, of course, Jeremiah Sams is asking this question. What is your thoughts on using plastic for paying your mortgage? ? It allows you to use your credit for a small fee. So that's the only question we have, Jared. But I did want to pose that to Don, see if he has any thoughts on that one.
All right. For the most part, you can't use credit to pay for credit. Okay. For the most part, you can't use a credit card to make a payment on the mortgage. there's some workarounds, but you don't want to do that on your own. You definitely want your computer system, our computer system, to help set that up for you so you don't make some serious mistakes. There's some workarounds on how you can use your credit card and get the cash off without paying cash advance fees. All right. But you've got to be very careful when you do something like that. This is one of those things that you do not want to try at home. And I'm reluctant to even start that conversation in this particular forum because I can't give you all the pieces and parts in the time that we have allotted. All right. So for the most part, you can't use credit cards to pay mortgages, but there is a workaround so that you can use the credit card system's money in such a way that it can benefit you greatly, but it takes a lot of instruction. All right. So if you want to find out how to do that, folks, contact us. Put in your information at ice10klive.com. Click on Get a Savings and Earnings Report. And when we do that for you so that you can know the month, day, and year you could be debt free and how much interest you can save, just bring up that question. How did I use credit to make my situation better? And that way we can go into this in detail and keep you out of trouble. Do not try this on your own without instruction. I guarantee you it can hurt you. In fact, it almost brought this kind of thinking almost brought the Australian economy to a screeching halt. They had a situation similar, and and you've heard of 60 Minutes? Well, Australia has a version of 60 Minutes, and if you look for it, 60 Minutes Australia, and look for the credit crisis, do a Google search, you will see what they were talking about. They were using a similar situation, using lines of credit, and got in serious trouble and almost brought the Australian economy down. So if it can bring a whole economy down, what can it do for you? So listen, folks, and that's why I have a bunch of Australian clients today, is because of that a financial meltdown. So they wanted to avoid that. So now there are a bunch of them who are Pill Method clients. Okay. All right. Who's next?
All right, this is Jared speaking. So I just want to recognize Chris Monroe for coming up. Happy Clubhouse anniversary. And we're actually streaming this on YouTube, Twitter, Facebook, and LinkedIn. So Chris, love for you to quickly introduce yourself and let people know what you do and how they can get a hold of you.
Great, Jared. Thank you for bringing me up. Chris Monroe, real estate investor out of St. Louis, Missouri. Just enjoying the content. I actually jumped over to the YouTube stream as you were going through that example, Don, and wow, knocked out all of that interest in the blink of an eye. I love it. But I did have a question in regards to that. In the event, when you were looking at that and basically paying that one-time interest, that 1 month's interest versus a year's worth of interest, is that always best to do in yearly increments, or can that be broken down into months, or if you want to do 2 years worth? Go a little deeper into that if you can, Don. And thanks for bringing me up again, Jerry.
All right, Chris, listen, thank you very much. And listen, and happy Clubhouse anniversary, Chris. Listen, folks, Chris is a wealth of knowledge on this app. So if you want to know anything about real estate investing, he is your guy. Tap into him right now, follow him right now, and ask all sorts of questions about real estate investing. And he has a course that's out of this world. So Chris, to answer your question, for each client, there is a specific amount of money that's going to save you the most amount of money per dollar applied. What we're giving is overall answers so that people can have an idea of what it means to cancel interest. So here's why we do this. By putting extra money on the debt, most people have no idea how much interest they just saved. And the purpose of the example that you saw is just to say, oh, I didn't realize that we could save this much interest. So our program will take each individual client, take a look at their financial footprint, and then make recommendations as to when to put the money down, how much to put down, which loan to attack, and we're going to tell them to the penny how much to prepay. So we don't leave it up to chance at all. And so if we have two neighbors side by side, all right, they could work at the same place, but they will get two different recommendations from our computer program because their finances aren't the same. But the quick answer is yes, you can break this down to whether the program could say for you it would be you need to pay $327. For the next person, it could say, well, you've saved up $3,847.26. You need to pay that towards your mortgage. So it's variable. It could be any amount, but whatever the amount is, it's going to be optimum for that client or for that business to make sure that they're saving the maximum amount of interest per dollar. Does that help, Chris?
100%. So it's basically tailored to each individual client and their specific situation is what I'm hearing. A follow-up question with that. Now, I know we're talking about mortgages, but I have a fleet of cars and a couple of them have some loans on them. Does this work on automobile loans as well?
Oh my goodness, Chris. Not only does it work on automobile loans, but we're going to help you to choose which loan to attack, because most people would say, oh, I've got an automobile loan that's almost paid off. Let me give you an example of what we're talking about here. So I've got, let's say we have an auto loan that started out around $30,000. Okay, ooh, that's 300,000, 30,000. And let's say you got a really good interest rate on that, 1.99. All right. And then we had it for 5 years. Boom, 60 months. And now the payment is $527.70. All right. Now look at this. The total interest cost on this loan is only $1,542. Okay. When I say only because it's, when you compare it to like a mortgage or something. All right. So now, when we are 3 years into this loan. Okay. 3 years into this loan. 3 years in. So we're at 36 months. 36 months. Let me see. 30,000. Okay. 1.99. Okay. 60 months in. We are. Okay. So here's the cumulative principal and cumulative interest. Okay. So once we are 3 years in, 36 months, we're at 17,000 we've paid back, and we've paid back in interest $1,284.27. Okay. So out of the $1,500 in interest we're supposed to pay, we've already paid $1,200 of it. So somebody might say, well, I've only got a little bit to pay off. Why don't I pay off this loan because I owe the least amount on it? Well, you don't pay off a loan just to pay it off, Chris. You pay it off because of how much interest I can save. I got cars with loans where I owe more interest than I do this one. So why would I take my money to pay off this loan? Because I still owe $12,000. I could take 12 grand, pay this loan off and be done. But for 1284, I owe less than $300 interest on this. By paying off the $12,000, I only save a little more than $200 in interest on this particular loan, where that $12,000 would save me a lot more money in interest on another loan that was newer. So not only are we going to help you to pay off your fleet, we're going to show you how to do it in such a way that you pay off the right loan at the right time, so you save the most amount of money in interest. Chris, how does that sound?
Wow. Changing lives through killing the interest. I love it, Don. And so, this program works perfect for a person with mortgages, multiple cars. Can they set up all of that within your same program at once for that one client?
My goodness, Chris, you're asking all the right questions. You are asking all the right questions. So let me go ahead and while while we're doing that, tell us a little more about what you do, Chris, and I'll set up the next example so that so we can see what you're talking about. Okay.
100%. So yes, like I said, I do have a fleet of cars up on the app called Turo and another one called Hire Car. So we buy cars. Most of the time they're bought cash, but I do have a few that are financed. And you start looking at that interest rate, and it's like, wait a minute, the more cars I put on finance, the higher the interest rate goes. So just looking at the numbers, and you're talking about canceling interest, that sounds like a game changer. I do have a portfolio of houses as well, with some loans on them. And when you start implementing this strategy into multiple automobiles, multiple houses, and anything else with interest, which I was going to ask as well, could work on other things. It's a game changer. It's actually going to make more income by not giving the bank interest payments and making more of your money go work for you. And that's what I'm trying to do with my money. So that's why I'm asking these good questions. So, people that are thinking about this stuff can actually understand how they can make more money by just paying the right places at the right times and using your method, Don.
Well, listen, Chris, what we're doing now is I'm putting on an example of our opportunity cost calculator. And why we call it an opportunity cost calculator is because opportunity cost simply means if I spend my money one way, I can't also spend it another way. For instance, I buy a television at Walmart, all right, and I pay for that television. That same television is at Costco for $100 less. Okay. Since I've already spent the money on the television at Walmart, now because of opportunity cost, that's called an opportunity cost lost because I've already spent the money at Walmart. I could have spent it at a Costco and saved $100, but that $100 is now gone. Opportunity cost lost. So what we're trying to figure out is how can we make sure that whenever we pay for something, whenever we purchase something, we take a look at not only am I making a good deal when I purchase the car, because I happen to know a little bit by listening to you, Chris, how to buy a Turo car, how to buy my car that's going to go on Hire Car. What he does, folks, and I listened to him. So he says, buy the car at such a price that when you insure it, if it gets totaled out, you actually are going to get a check for more than what you bought the car for. Is that right, Chris?
Yes, sir. We win either way, no matter what.
All right. So listen, man, I've been listening. So now we bought these cars right. So we're doing what we can to buy them right. Let's pay for them right. Okay. We bought them right. Let's pay for them right. So let me give you an example here. This is John and Rebecca Jones. All right. And John and Rebecca Jones, we got years to pay off here. They've got an automobile, they've got a credit card, and they've got a mortgage. So if we go into their accounts, we can actually see that they have $500 in checking, they have $5,000 in savings, and they have a $25,000 auto loan here. All right. And they have a credit card at 21%, and they have a $200,000 mortgage. Now, I don't have an example with multiple cars, so we're just going to kind of use this, Chris, to kind of give you an example of what we're talking about. All right. So if I go back to the action plan here, the program tells us just to track their income. John gets paid here on October 1st, $950. We would tell the program, oh, John got paid. All right. And then we would tell the program, well, he got paid his $950, and add that to his virtual checking account, because that same money got added to his real checking account. Now he has $1,450 in the virtual account. He has $1,450 in the real account. So now we're going to also tell the program how much he's spending. The mortgage, the utilities, we get another paycheck, but here is the magic right here, okay? The magic of the math. These little arrows tell the program tells you take money from the checking account and put into savings. this $100.90. Because for this family, this is $100.90 they don't need for anything else because they've told the program how much they need to spend each month. All right. And so the program just tells you to put money in savings until it's time to take it out. So in respect for time, we're going to scroll down to December when the program is saying, oh, we need to take money out of savings because this is money we saved up and pay off the Visa at one time. When we do that, when we pay off the Visa, then it tells us, oh, here's how much interest you saved. $1,736.34 in interest by paying off that Visa. And then it says, after you pay off the Visa, then after you pay your mortgage on the 1st of the month, then the program is saying, wait till the 7th of the month. And here's what you were talking about, Chris. It's going to tell you to pay $1,116.98 on the mortgage principal. Stop at the 98 cents. Don't even round it up to the next dollar, Chris. I mean, this is very specific. This is the optimum amount to put down on this mortgage so you could save the maximum amount of interest per dollar applied. Any more than this, the amount of interest you could save per dollar goes down. Let me give you an example. Let's say you could save $4 in interest for every dollar you apply to principal. But if you do it wrong, you would save, let's say, $3.50 per dollar. You're still saving. But why would you accept $3.50 per dollar when you can get $4 in interest saved per dollar? And because we're not tracking how much interest we save, you can't optimize what you can't measure. And we've been taught not to measure. We make huge mistakes, opportunity cost mistakes, by just willy-nilly putting money on the debt, not knowing how much interest we're saving. This way is more precise. You're going to save the maximum amount of interest per dollar. So we're going to put this on here. And when we do that, Chris, on this particular mortgage, by putting this amount on, we will save $5,435.91 in interest by putting that amount of money on the debt. Now, here's why I think that this is important. We just paid off the credit card. Let's go back to the accounts. We just paid off the credit card. And here is the minimum payment for the credit card is $50.88. There is a common way to pay off debt called the debt snowball, Chris. All right. In the debt snowball, when you pay off a loan, you take the minimum payment that you used to pay on the other loan and add it to your payment on the next loan. It's called the snowball. So you keep snowballing those payments to pay off the next debt. And what they generally do is pay off the next largest debt. The next largest debt here is the automobile. By paying off the automobile next, now we can take the payment for the credit card, we add the automobile payment of $460.41, and we add that to now the mortgage payment, where we're putting an extra $510 on the mortgage every month. That's called the debt snowball. Let me tell you why it is important to pay off the right loan at the right time and not just follow a rule of thumb like the debt snowball. Okay, so let's take a look at this thing. So which loan should we concentrate on after we pay off the mortgage? What should we do with this $50.88? So what we're going to do is take a look at, go into preferences, all right? And we're going to take a look at something, and we're going to focus on our system settings. And in the system settings, it says, listen, it's set up for automatic, all right? It's set up for the automatic to pay off the debt. So we can go into focus settings, all right? It's set up for automatic, all right? Now, we're going to be able to pay off, because of this program, we're going to be able to pay off the mortgage of $200,000, the credit card of $2,000, and the automobile $25,000 in 7.7 years. Wow. because we're saving $179,448 in interest we will never have to pay. We know that up front. By putting this on automatic, the program chooses which loan and how much to put down. So if we follow, I can override the program and says, you know what? I want to follow the guy that says use the debt snowball. So we're going to focus, we're going to take that money that we're no longer paying on the credit card, and we're going to put it on the auto loan and pay off the auto loan 2 years early by focusing on that. Okay. Watch what happens to the 7.7 years and the $179,000 in interest save when I choose the auto loan. Specifically, the program recalculates and says, oh, it's going to actually take us longer to get out of debt, now 7.8 years, and the $179,000 in interest save just dropped by $2,000. You mean if I pay off the car early, it's actually going to cost me $2,000 more in interest? Let me show you why that is, Chris, and that'll be the total answer to your question. So we're going to change this back to automatic. We're going to go into accounts and take a look at the breakdown on the auto loan. So we break this auto loan down, okay? We get to see that maybe I need to make this just a little bit larger, all right? We get to see that the interest payments on the auto loan are only $83.33. If we attack this auto loan, we get to save interest on it, but our interest payments start out at $83 and go down from there. So the amount of interest that we could save is significant when we're just looking at the car. But if I focus on the car and my interest payments are $83, that means I'm paying minimum payments on the mortgage because all of our effort, all of our extra money is going to pay off the $25,000 car because it's cheaper than the house. But watch this. When I go into history here and take a look at this, answer me this. Should I focus on the loan that's only costing me $83 a month for the next 2 years and leave this alone while I'm paying $1,000 to $900 a month on my mortgage and just totally ignore this? Chris, what do you think?
I'm thinking to pay the one that's going to cost us the most. That's what I'm thinking.
Okay, exactly. Now, the car is still going to pay off before the mortgage, but the program is going to tell you when it's time to put money on the car and when it's time to put money on the mortgage. So you're not paying for the next 2 years, $24,000 in interest just to pay off a car that is only costing you $83 a month. So it's very important when you have a fleet of cars, Chris, to know which one to attack and when. And I'll give you one more piece on this thing. So if you have 5 cars, Chris, that have you have loans on, all right, and we're going to pick the most expensive car, the most expensive loan amount. Expensive not in the form of interest rate, but interest cost. How much does it cost me in interest? That's the one we want to focus on. So if we start out on car number 5, which has the highest interest cost, is it possible to pay that car down so it costs less than car number 4?
Now you're cooking with grease. I see it, Don.
You see it now. So what the debt snowball says, we're going to pick one and pay it to 0. Why would you pick one and pay it to 0 when there's going to be a time when car 5 is going to cost less than car 4? When you pay a loan down, when it's less than another loan, you switch up and go to the more expensive loan now. Does that make sense, Chris?
Makes total sense. It's seeping in slowly for even the people in the back as well. Now I'm looking at this on YouTube as you're going through this example.
Yes.
Now, how simple or easy is it for people that call themselves not so computer literate to follow the program? Is it pretty simple as it appears on the screen? What do you say to those people that feel like they're not so computer literate?
Chris, my man, you're asking all the right questions here So what we're going to do is we're going to stop sharing this screen, and we're going to share another screen, and we're going to put that up. We're going to go back over here, boom, and share this. All right. So here's what we tell them, Chris. For every person that becomes a client, here are the benefits and features to our program. We're going to put that on the screen right now. Okay, here are the benefits and features of this right now. So one of the things that we show them, Chris, is that along with all these other benefits, okay, here's one that we show them. We're going to give them a lifetime toll-free customer service number that's open from 8 a.m. to 6 p.m. Mountain Time. That's 10 a.m. to 7 p.m. Eastern Time. All right, to call and ask questions. Now, we're not talking about email customer service, Chris. We're not talking about leave a message and somebody calls you back. We're talking about customer service line that's U.S. based. What did I say? U.S. based, because our customer service is in Salt Lake City, Utah. All right. And when they call, somebody answers the phone and answers their question. And here's how our customer service is set up, Chris. You don't call customer service when you think you have a problem. You call our customer service when you have a question, because our customer service is set up like teachers in a classroom. Got a question? Raise your hand. How many times can you have a question in a day? 10 times? Call 10 times. 15 times? Call 15 times and get an answer to your question, and you'll get the same pleasant customer service treatment on the 20th call as you did the first call. And how do I know that? Because you're going to get a survey each time you call. And if I get one of those surveys back that says that you were treated badly, I'm going to find out and I'm going to fix it for you. Go ahead, Chris. What else you got?
You're making it so easy. How can one say no? So who is this more so for? A person with just limited debt, a person with tons of debt? Who do you feel like this is a perfect play for?
Well, I tell you what, you could have a small amount of debt, or you could have tons of debt. Here is another example, Chris. Listen, if you keep this up, people are going to think I paid you to do this.
I'm just naturally a good question asker, Don.
I'm telling you, because
I know what people are thinking before they think it sometimes. It's my psychic ability. Don't tell them.
Wow. So here is an example of a client with multiple properties, okay? And here's what's now, so we can handle like $80,000 worth of debt or 80 million, doesn't matter. We just plug it all in. So here's a client with multiple properties. And this is what happened, what she was doing before we met her. On property number one, which is at 4.25% interest rate after 251 months, okay? Paid this property down by $150,000, but it cost $183,000 in interest to do it. And as you can see here, this one at 6%, the bank really wants 115.838% of what she borrowed in the form of interest. So in 157 months, she's only paid this loan down by $32,500, but it costs $96,000 in interest to do that, Chris. So why did she not pay attention to the interest cost? And here's why. Because she bought the properties right, and she's renting them outright, and she's cash flowing like crazy. She's done everything that real estate investors teach, except real estate investors do not teach, pay attention to the interest cost on these loans. So if we take a look at all the interest costs on these loans, okay, so if we pay attention to all the interest costs on these loans, then we can add that up. And over the time that we add up the interest and the principal, Chris, it comes to $1,179,038.45 in total that she's paid out. Now, here's my question. When you receive your rent money, how much of that money is yours? When you receive your rent money, how much of that money is yours? All of it. Now, how much of it do you want to keep? That's the next question. Okay. Because out of the $179,000, $1,179,000 she received in rent, most of it went to interest because she's only paid down her principal. This is her potential equity, $415,000. But it cost her $763,000 in interest paid out to get $415,000 in potential equity. Wow. So with this, so now here's how much she still owes on the property, Chris. $1,292,000. And the bank wants, even now, from this point on, $651,000 in interest. By using this methodology, she's going to gain equity at 5 times the regular rate and pay a lot less interest. So instead of paying the bank $651,000 in interest, she's only going to pay $236,000 using the same methodology, right? As the P.I.L.L method, and be done in 7.6 years. Interest savings, $419,991.07. So, Chris, if the bank receives that $419,000, what are they going to do with it?
You're going to reinvest.
If she,
now, I don't want to take it too deep, Don, but I want to know.
Yeah.
You know, there's people out here that believe, paying that interest is going to be a good tax write-off. What do you say to those people thinking about stuff like that?
Well, listen, that is a very good question. And so when I do a seminar, Chris, I have in my pocket $1 in one hand and 27 cents in the other. You got to pay $1 in interest to get 27 cents back from the government. Do you know that I really do believe that banking lobbies Congress so that you can get that tax write-off on your interest? Because the banking industry gets the whole dollar and the government gives you back 27 cents on your taxes. The banks receive the whole dollar. They're happy. Okay. So here's what we're saying about that. Every year you have a mortgage and you qualify. Not everybody qualifies, but every year you have a mortgage and you qualify for your tax breaks, you're going to get it. You just won't get it for 30 years. You're going to get it for an average of 7 years. But when you pay off the house, when you pay off the loan, doggone it, Chris, you lose the 27 cents tax break. But you get to keep the dollar to invest any way you want. How does that sound?
That sounds like a smarter and better move for sure.
Chris, you are amazing.
100%. Now, my psychic ability is telling me that somebody in their brain is wondering, how much does it cost to become a client? Is it month to month? Is it yearly? How does that part work, Don?
Listen, that is an excellent question. All right. So if we take a look at this client who has $1 million in property, okay, over $1 million in property, and I have another client that has $80,000 in student loans. Do you think those two clients pay the same thing for this service?
I would hope so.
Yeah. So here's what we're talking about, Chris. Here's what we're talking about. We're going to take each client, put in, because we have over 20 price points, so that we can make sure that whatever the client, whatever needs they have, what they pay for this program is going to be commensurate with how much interest they can save, which actually pays for the program. All right. So I've had some people say, well, Don, whatever price you told me, so it's X amount. It says, is there something you can do with that price? I said, well, here's what we're doing. Before you met me, you paid a lot of money in interest. Okay. So before you met me, right, you paid In this case, you paid $700,000, $763,000 in interest just to get $415,000 in principal paid. Now I'm going to show you how to pay $236,000 in interest to pay off 1.2 million and save 419,000. I just want a small percentage of the 419,000. So here's what I'm talking about. The money that pays for this service is money you would have paid in interest. It's not extra money. It's not different money. It's money you would have paid anyhow. So pay us the little bit of money of the interest saved. You keep the rest and everybody's happy. So I'm not looking for any extra money. I'm just looking for a small piece of the money you would have paid the bank anyhow. Chris, does that help?
It definitely does. So it's a custom program for every potential person. So they would have to get a consultation.
Yes.
Figure out what strategy or which plan works best. They'll get a quote, I guess, at that point, and then they can move forward. Is that how it works?
That's exactly how it works. And what they'll do is they'll go to ice10k.com, ice10klive.com, or right above our heads, click the link, and there's a button that says get a savings and earnings report. Follow the directions. Fill out the financial form once you get access to it. And then someone from my staff will give you a call, confirm the numbers, and then set up a consultation. You'll know the month, day, and year you'll be debt free. You'll know how much interest you could save, and you'll know what the fee is because it's going to be a very small percentage of the interest saved. Chris, you're right on point here.
Well, glad I can contribute and ask some questions that may be burning in people's brains. I know most of them are burning in my brain, and hopefully, people take advantage of this because, this is definitely a game changer. Thanks again, Don.
You're so welcome, Chris. Listen, we got Sean 10K, who is another businessman. What do you think about all those questions, Sean?
I don't think I know Chris is a damn genius. And what I know about Chris as well is that Chris already see the pathway, but he tried to inspire others by asking the right questions. So shout out to you, Chris. I love that.
All right. Jared, back to you, sir.
All right, Kirk, we have a question on LinkedIn, I believe.
Yes. We do have a couple of questions coming in from online. From our online audience. We want to say a word of welcome to all you guys that are out there, 20-something people that are out there right now. Thank you so much. And again, Chris, those questions really did help. We saw some of the comments coming in as you were asking those questions. You were definitely reading some minds this morning. Sonia on LinkedIn. I want to welcome our folks on LinkedIn. For those that don't know, we are on LinkedIn as well. But Sonia on LinkedIn had a question. Well, first she commented saying that this is great, but she kind of gave her details. She says, what about a $257,000 VA loan that's 30 years and at 2.25%? I think she sent this in as you were doing the example with one of the previous people on the stage. So she was just asking what would that credit look like is what I'm assuming. Sonia, I'm not certain if you're still there or if you changed platforms, but if you want to jump back in the comments and let us know that you're still there. But this is the question we have on the screen here, Don.
Okay, so here what we're going to take a look at is we're going to put this. Actually, we're going to go ahead and put this on the screen, and we're going to cover a little bit of that. And using our psychic abilities, we're just going to go over some ideas here. All right,
Cool.
Some things that people have said. Now, one of these things that we've got $257,000 here at $257,000 at 2.225%.
That's right.
Do you know how many people have come to me and said, Don, why even focus on this when the interest rate is so doggone low? And I had this question last night, and somebody challenged us. Why should we pay off a loan that is 2.225% when I could take that same money and invest it in some sort of vehicle that's going to make our clients 8, 9, 10, 12% in their investments, why pay off a loan that's only costing us 2.225? It's a very good question. All right. So why pay attention to this? All right. So number one, before we even get into this, every client we talk to, every client we talk to that has money going into investments already, that's working with an investment counselor, we don't touch a dime of that money that's going into investments, not a dime of it. It continues to go to the investment so that can make compound interest on that money. Are you hearing me? Okay. So what we do is we take a look at, and here's the thinking. Why pay off a 2% loan when I can make 10% in my investments? And my direct answer to that is you would never pay off a 2% loan so that you can avoid making 10% in your investments. So I'm in total agreement with you there. But let's take a look at this loan and see what it was really going on here. On 257,000 at 2.225, here's the amount of interest that the bank wants: $95,476. Okay, let's make that just a little bit bigger so we can see these numbers better. Okay, 95,476. That's not 2%. That's not 2.225. That's 37% of what they borrowed that they must pay in interest if they don't pay attention to this loan. Okay, so here's what we're looking at. Okay, in the first year on this loan, they're going to pay it down by $6,092.85. And the interest cost on that is $5,656.35. So here's my thing. When we're trying to figure out profit, what we're taking is what are we getting for that money? What are we getting? We're getting equity here. When we're trying to figure out equity, we're taking and figuring out what does it cost us to get the equity. So now I've got equity. Here's how much I owe on the house. But what we're not doing is subtracting the interest cost from the equity received. Oh my gosh. That's not that we're missing an opportunity here. So we subtract the $5,656 from the $6,000. We end up, oh, it's not $6,000 in equity after all. If I take a look at the amount of interest that I have to pay to get it. All right. So here's what we're taking a look at, folks. When it comes to interest cost, don't underestimate interest costs just because you have a low interest rate. A low interest rate does not mean a low interest cost. It's still too much money. So what we need to compare, and this is the problem when you're comparing interest rates like that. Why pay off a 2% loan when I can make 10% in the market or whatever? Well, you're comparing an amortized loan with compound interest. Amortized interest and compound interest. That's apples and oranges. So when you compare amortized interest against compound interest, here's what I want to do. I want to make sure that I have the right amount of my money that's going to an investment so that we can make that money. I want to take what's left over and strategically save money in interest on this loan. Instead of paying the bank $95,000 to acquire this property. So here is the true cost on this loan. It's $257,000 plus the $95,000. Here's the true cost, $352,000. So you just signed up to pay $352,000 for a property in a $257,000 neighborhood. That's what you've just done. So what we can do is see what we can do to cut our costs. You can't, once the contract is struck, you can't do much about what you borrowed, but you can do something about what it costs to manage what you borrowed. What if we could acquire the same property for not $95,000 in interest, but what if we could acquire the same property for $30,000 in interest or less? Then now we can take the 60 grand that we didn't have to pay and invest that in something else. Listen, folks, we have been sold a bill of goods when it comes to understanding how amortization works and how it's siphoning off our wealth. You can cut those interest costs by 75%, and you don't have to change your budget. You don't have to refi, and you don't have to sacrifice lifestyle, meaning you don't have to eat beans and rice every day. You don't have to eat ramen noodles every day. You don't have to drive a 30-year-old car. You don't have to do your own hair, your own nails. You can actually, you don't have to stay home and not go on vacation. You don't have to sell pizza at night to take that extra money and throw all of that money at the loan. Folks, you can live well and only pay $30,000 in interest on this loan.
That's amazing.
Cut out all of that extra stuff. Cut out all that extra interest. Live well. Create memories with your family, because we're going to budget your fund money right into the program. You tell us how much you want to spend on your fund. We plug it in, and then we're going to take what's ever left over and kill interest with it. Let me give you one example of how small amounts of money kill interest. I had a client call me up from California. He said, Don, by following your program, we're tracking how much we're spending on our grocery budget. This month, we spent our entire budget except for $4.69. The P.I.L.L Method program asked us to put the $4.69 in savings to be used later to eliminate interest. When we put the $4.69 in savings, the program recalculated our interest savings and told us we're going to save now an additional $35 in interest for that $4.69. Folks, if you know that your $4.69 left over from your food budget is going to save you $35 in interest you don't have to pay, isn't that valuable? Or you can try to buy a burger and fries with that money.
Extremely valuable. Extremely valuable.
What else we got going on?
Hey, Don. So I wanted to, I wanted you to tell the people about, what I think is probably the most valuable stocking stuffer or Christmas present anybody could give anyone in their lives. Your best-selling book, The P.I.L.L Method. Just tell people a little bit about it, and also the partnership you have with 10K to make that purchase even more of a value add.
Listen, folks, the information that you are hearing today is not because that I'm a math genius. It is because I have what's called Asperger's. I look at an amortization schedule, and I see the patterns here, and it doesn't make sense to do what we've been taught to do. It makes sense to do some of the things that I'm explaining to you here to take advantage of the amortization schedule. It is set up so it makes maximum money for the banking system. Now, I'm not anti-bank. I love the bank. Why? Because that's where the money is. When I want to buy a property, I go to the bank. If I want to buy a car, I go to the bank. I don't use my cash. My cash is out there making babies, okay? I'm not using my money to buy houses or cars. All right, I'm using the bank's money. But because of the amortization schedule is set up to make so much money, there's an inherent weakness in their system. Here's the weakness. You can never know how the system works. That's why it is not taught at any level of financial education. Your CPA doesn't know how a loan works. Your financial planner doesn't know how a loan works. Your real estate agent doesn't know how a loan works. Even the person that sold you a mortgage does not know how a mortgage works, because they don't need to know to get their license. Therefore, it's not covered in their education. So how could they know? How could they pass on that information? And every person I talk to, even though they're not in the business, I could ask them, have you ever received an education on how an amortization schedule works, how the bank makes their money, and how to defeat their system, I get the answer no across the board. This is the reason for this book. It is a miracle in it of itself. Because I have Asperger's, somebody said, you need to put this in a book and share it. I said, I didn't, because I also have ADD. I didn't read my first book all the way through, ladies and gentlemen, until I was 46 years of age, because with I kept reading the same paragraph over and over and over again. It wasn't sticking, but because of a little bit of education, because of a little bit of people working with me, I was able to start slowly beginning to read. And I started out on audiobooks and then transitioned into books that I could hold in my hand. And eventually, a person who didn't read a book until he was 46 years of age, with Asperger's, who sees patterns and pictures, found a way to explain all of this, got a copyright for it, and put it in a book. And out of 33 million titles on Amazon, there's only one book that talks about how to read an amortization schedule and how to defeat it. And it's this one. And folks, it's worth its weight in gold. It's 6 ounces. The book is 6 ounces. And gold is what, $1,600 an ounce? It's worth more than that. But if you go on Amazon and get this book, go to ice10klive.com, ice10klive.com, the button, the link that's above my head. You can find out how to get the book. And once you get the book, because of our partnership with 10K Cards, every book you purchase, you can get a 10K card that goes along with that, and not only use the book as a stocking stuffer, but you can make a valuable present of the 10K card to whoever you wish just because you bought the book. 10K, why is that so valuable?
Oh man, what a smart question, Don. First of all, I'm gonna call Don out on his capping. Don is trying to avoid the math genius title, and Don, I'm here to tell you, our perception is our reality. So when we choose to call you math genius, that is our reality, and I'm sticking to my story. That's number one.
Okay.
Number two, 2022 is coming, guys. I'm gonna be extremely intentional and laser focused about the success that we're gonna achieve, not only for us but our friends. So anyone in this room that's really looking to up their game, anyone in this room that is very serious about moving their financial game up another level, definitely get a copy of Don's book. You click on his card, go to the top left button, and you go onto Amazon and get a copy of his book. That's step one. Step two, when you get the book and you consume the information, you're going to have to do something that's called taking action. Taking action means act on the information you got from Don and click on the button that says get a savings and earning report. Submit your information, guys, and see if the program is right for you. If the program is right for you, pull the trigger, take action. When you purchase your book as well, you can simply click on the button that says I'm ready, submit a copy of your receipt, and claim your 10K card. Don recognizes the power of the 10K cards and how it can help with his business as well. And he also want to extend that kind of help to his audience as well. So when you get a copy of Don's book, you get to claim a 10K card that's already paid for by Don. Guys, no more sleeping. Anyone to reach out to me in my back channel, anyone reach out to me by text message, and I know you were in Don's room. If I ask you if you have a copy of Don's book, and you said no, don't be surprised if I don't respond. Take action, guys. I'm not here to waste time. I don't know what's up with the other moderators, but if you're going to come into my circle, I'm going to hold you accountable. So, guys, two things. Make sure you have a copy of Don's book. Make sure you have a 10K card. If you have those two things, I cannot speak the language that you're speaking. Those are the two qualifiers from now on. With that said, Don, back to you, my brother.
Listen, I got a couple of questions for a couple of moderators on the stage. If Kenyatta is in the house, Kenyatta, based on what you know to be true here, when you help somebody get a loan, what is the next thing you're going to do once you help them to get a loan on their new property, their new rental property? What are you going? What's the next best step?
The next best step is to then invite them to the P.I.L.L method, because my goal then will be for them to hurry up and pay that off as cost efficient as possible so we can get them into another loan.
So why would a person who makes their money from lending, why would they ever work with the P.I.L.L method?
Oh, it's genius, right? Because it goes together. It's a perfect marriage. Because you're generating a loan doesn't mean that you're done with that client. If you're a relationship-based person like I am, the name of the game is to help them with their overall goal. So instead of sending them out into the blind, you want to educate them on all the best strategies, whether that be 1031 exchange or in this case, the P.I.L.L method, on how to actually save on interest. Is genius. And then you look like the expert, right? And so you want to make sure that they know that you're their connect to all things money. And so, yeah, it's a perfect marriage.
All right. So, Miss Credit Goddess, if you're still in the house, what if their credit isn't quite up to snuff? Is there anything that we can do to help them to qualify for a loan, and so that they can engage all of these other services?
Yes. To answer the first question, to see if they qualify for the loan, I suggest that they speak with a mortgage broker to see what their options are, right? And then once we have some type of guidelines or knowing what the requirements are, if they are below the requirements, if they're not meeting the requirements, then they can book a consultation with me and see what strategies that we can implement to get their scores where it needs to be to then qualify. There could be different reasons why your scores are low. It could be that you are overextended on your credit cards. It could be that you are riddled with collections that are weighing your scores down. So just because your scores are low doesn't mean that you have bad credit. It can be many, many factors. I like Jerry Malcolm would say, I don't believe in giving a prescription without a diagnosis. Sometimes we tend to self-diagnose what our credit situation is. We read articles and things like that. We try it and it doesn't work. I suggest that you book a consultation with any credit expert, including myself, and I will give you a detailed credit analysis of what's affecting your credit and what we need to do to improve it. So yes, if any of you guys are looking to do that, book a detailed credit analysis service in my creditgoddess10k.com. That's the detailed credit analysis. That way we can break it down and tell you exactly what you need to do. Whether you hire me for services or not, at least you have a blueprint and you can start from there. So that's my answer.
Thank you very much. Hey, Jared, why is it important to have a well-curated stage like we have here today, sir?
Your network is your net worth. And with all the different skill sets that are on this stage, you're pretty much covered. Also, we just want to make sure that we're serving our people that follow us. So by us being on this stage, our followers have the opportunity to, engage with you and get this, groundbreaking method. So we really appreciate everybody for being on the stage. And if you're in the audience, I highly recommend that you follow Don, click that bell icon, and click the always on notifications, because if he's on Clubhouse, it's a 9 out of 10. He's talking about generational wealth, financial literacy, and the P.I.L.L method, and he's surrounded by amazing professionals that really pour into people daily, like the people on this stage. So definitely want to follow Credit Goddess, YCEO, Kirk, Kenyatta, Coffee Brown, Chris, and my man 10K Cards. If you're interested in following me, I promise to do my best to bring you into rooms that are going to add value to you and give you more information than you left Clubhouse with. So that, in my opinion, that's why it's so important to have a stage like this.
Thank you very much for that. So what's next on our agenda this morning, sir?
All right. So Kirk, do we have any more questions from the stream?
Yeah, actually, we do. But I want to say, Don, you did answer one of them, right? So that was pretty cool. Facebook user, unfortunately, we don't have your name. I'm assuming you're in the P.I.L.L method group on Facebook. That's the only time where we don't get the names. But his first question was an obvious question, right? Don't you have to have discretionary income in order to make this work? And you kind of touched on this, Don, when you talked about the $4.32 and how that can still save you some money. So I put that question up at the time you were saying that, because I figured that was going to touch on his question there. There's another question from the same person. I'm assuming it's the same person. They were in that same vein, right? I have a couple of other streams of 1099 income that is not a set amount. Can different dollar amounts be entered into the program to figure out how fast to pay off the mortgage? And I responded to them in the comments, just saying yes. And you were sharing that example when Chris was with us, showing the details of the system itself. But I did want to just bring that on screen. Here's a question I want you to touch on, because I know we don't have time.
Yes.
All Pro, looks like All Pro is also in the room on Clubhouse. And they're saying, hey, this is Bananas. Love the room. How does this apply to refinancing? Trying to make the correlation. And then the follow up was, does it make the refi good, or usually keep the original loan? And I know you have a specific answer to that one, so I'm going to let you loose, Doc.
The specific answer is it depends. So here's what you want to know, folks. I just had a client here just yesterday that asked me this question. They have a loan that's over $1 million, and that is significant in trying to figure out the numbers. So you can't answer that question without doing the math. Okay, what we're talking about is not magic, it's math. Okay, so if you have a $1 million mortgage or a $200,000 mortgage and the interest rates that are involved, it all depends. But here's what you want to know for sure. It doesn't matter what your payment is or what you can get it to. It doesn't matter what your interest rate can be. This is not why you refinance. What we're looking at is, how much is it going to cost me overall in interest cost to make this decision?
Right.
What is it going to cost me? So if I can refinance and get a lower cost by looking at all the math involved, then let's do that. So here's what we did for this particular client. They have over $1 million. So we took out their old loan and put in the new loan at a lower interest rate. They had 29 years left on their mortgage. We put the same 29 years in, and they were supposed to pay off this loan, their current loan, in 10.5 years. Now, because of the refi, they're going to now pay off in 10.3. Now, in P.I.L.L method speak, that's about a month difference. Okay, but when we put in all the numbers, it looks like they're going to save about $30,000 in interest by doing the refi. This time it worked out. Now, their refi is going to cost them $8,400. $8,400. Okay. I showed them if they roll the fee in and do like most people do, they just start making the minimum payments, and they're going to pay about $8,000 in interest on an $8,000 loan, making it a 100% loan. So even though they're going to save $30,000 in interest on this loan, I advise them to, when they, at the very first month that they make a payment, that they pay off the fee in 1 month, and then it'll jump down 4 or 5 months into their loan immediately. Pay off the fee immediately. Don't pay it off the way the banks want, or you're going to pay them 100% interest on that loan. Because when you roll your fee, your closing costs into the loan, you're just asking the bank, may I borrow $8,000? And will you just roll it into the loan and I'll pay you back? Well, the way they want 100% interest on that loan, but we're not going to pay that. So you have to be careful of those things. Now, here's the thing. Rarely it does work out that a refi will benefit you. A lot of times it does not. Keep the loan that you have and pay it off in 7 years. Okay. So as you saw, that the paying it off part, it didn't affect it that much. We're only saving about 1 month when it comes to paying off the loan long term. But because of how low the interest rate was, and because it's over $1 million, the savings is going to be about 30,000. Now, here's the thing. Here's the other thing they need to point out. On this particular loan, this client was told, if you refinance, you're going to save $95,000.
Wow.
You're going to save $95,000, which would be true if they kept the loan for 30 years. That would be true if they kept the loan for 30 years. And I had to point out to the client, but you're not going to keep your loan for 30 years. So all the numbers and figures and enticements they're throwing out to get the refi don't matter to you, because you're not going to keep the loan for 30 years. You're only going to be in it for 10. So everything we have to look at is for 10 years, not 30.
That's
so
right.
They're actually going to save 30,000 instead of 95,000, but it was still worth it to them to save the additional 30,000, even though it's going to make that much difference in the payoff time, but it will make a difference in the cost of managing the loan by about $30,000. So they're going to go ahead with it. There you go.
Yeah, that's good. That's good. I don't know, Jared, if we even have time for it, but we do have one more question that came in on YouTube, literally just in the last 2 seconds while Don was talking. So I just wanted to kind of get guidance from you, see if we can take this question real quick.
Yeah, it's up to Don. If Don has a little bit of cushion, then let's go for it.
Let's go.
All right. Well, here's the question. Good morning. Humblets on YouTube is saying, good morning, says, instead of refi of another 30 years, when there's 23 years left, would it make sense to get a mortgage at 23 years at 6% instead?
Well, like I said, and those are all good questions. And these are all variables that we need to consider.
Right.
But trying to get a rule of thumb that says, this is what I should do in this situation, a rule of thumb or a heuristic, and you want to take a look at that. Let me see if I can put that up on the screen. With heuristic, Heuristic. If we could put that up on the screen some kind of way, heuristic is nothing more than a rule of thumb. It's a shortcut, okay? But when we use shortcuts, we don't use all of the math involved. And when it comes to finances, this is what the banking industry has taught us, how to use a rule of thumb or a heuristic or a shortcut where everybody can use the same shortcut. And because of that, you're going to miss opportunities, and there's going to be a lot of opportunity cost lost because you don't do specific math on how much is it going to cost me to manage this loan. And if I don't do that math, I could end up paying more in cost than I wanted to. Yeah. And here's what we will need to keep in mind, folks. Just keep asking yourself this question, and you'll always do the math to find the answer. If by refinancing, I'm saving money, who would have to be losing money?
Yeah, that's the question.
And if that is the question, and you and that the answer gets stuck in your throat, it would be the bank would have to be losing money. Well, if every bank on every corner is trying to refinance everybody in the country, why would they set themselves up to lose money? They're making a ton of money. You just need to know where. And the only way that you can know how they're making money, and you're actually the one on the losing end of this stick, is to do the math. And when you do the math, you can know whether it's going to be a good idea to refinance or a bad idea to refinance. But you've got to do the math to figure out the cost. You cannot just look at what is the interest rate going to be, what is the term going to be, what is the payment going to be. You can't just look at that and make that decision. I can't look at that and make that decision. You've got to do the math and the number. Let me tell you something, folks. People will lie, but the numbers don't lie.
They won't. No, they won't.
People will lie, but numbers don't lie. And you need to see the numbers. You need empirical data to make these kinds of decisions, and stop using heuristics. Stop using rules of thumb when it comes to your money. You're spending your children's inheritance on interest. And there it is, folks, on your screen. That is the definition of heuristic. It's right there. So stop using them when it comes to your finances. Okay?
Yeah. Yeah.
There you
That's
go.
good. That's good. Well, Jared, I think that completes us on for the online questions. I want to kick it back over to you.
Awesome. Well, thanks again for another great room, everybody that asked questions. And thank you to all the moderators for hanging out. And we'll be doing moderator outros so that you can let people know what you do and how to get in touch with you on Clubhouse, as well as the 4 streaming platforms that we're on. But I would love for Don to go ahead and just close us out with how you can get in contact with him to figure out the day, month, and year you can be debt free. And then also just remind them what they can do in terms of buying the book and getting a 10K card.
One more time, folks. ICE10KLive.com, right above our heads. You can click the link right above our heads, find the button that says get a savings and earnings report, and follow all the directions. And the reason why we say that is because we're trying to keep robots out of our system. Okay. And so your cell phone number has to be verified. And when you verify that, you'll get a one-time passcode sent to your messages. Take the code and put it in. It will let you into the form. Once you get to the form, put in your financial data. Put in your financial data. Someone from our office will then contact you and then confirm that data and set you up with a consultation. And just so that you know, and most people want me to tell it, but for some reason, the information you're getting here is free. Once you call us and then we're spending individual time free with you, it's not free. But I'm telling you, the value is tremendous. You're going to get way more in value than the cost of our consultation. So it's going to be worth it to you. All right. So that's the next thing. So now, once you get that, once you get your evaluation, you're going to know the month, day, and year you're going to be debt free, how much interest you can save, and how you can take that interest savings and turn it into generational wealth by using compound interest. We're going to go over all of that with you and make sure that you get back. Listen to this now. It depends. If you're young enough, by the interest saved and properly taken care of, you can get back all the interest you've ever paid in life and then some. Oh my gosh. By using the money that the bank would have invested to enrich themselves, you can take that money and invest it in you and your family and create generational wealth, way more than any interest you've ever paid the bank in your life. Get it all back. Okay, work with us. We're going to show you how to do it. Plus, go ahead and get the book as well. Get it, and the great stocking stuffers. Get one for your family. Get one for your pastor. Get one for people that you work with. Get one for the mailman. Doggone it. Get a book for everybody that you can think of, and pass this information along. And we will set you up with a 10K card for each book purchased, so you can give that as well as a gift from us to you. Thank you very much, Jared.
Awesome. Yep. So we're going to go ahead and just go through the moderator outros. I'm going to try to keep mine within 30 seconds so that Don can get to all his clients. But my name is Jared Alberton. I've been in the tech space for over 15 years. My mission is to increase diversity in tech, as well as increase access to funding and support for diverse startup founders. So if you're interested in seeing my rooms on Clubhouse, all my replays are in my bio. And if those replays and subjects resonate with you, feel free to follow me so you can catch them live and you can jump on stage, ask your questions similar to the room we did today. Also, I am, part of the P.I.L.L Method mod squad, and we do this room Monday, Wednesday, and Friday, 8 a.m. Eastern time, and then Sunday at 9:30 a.m. Eastern time. Our next room will be on Wednesday, but we'll be taking Friday and Sunday off to spend time with the family for Christmas Eve and the day after Christmas. But we'll be right back at it on Monday, December 27th. So make sure you click the greenhouse at the top if you're in Clubhouse to follow the club. And also make sure you're following Don and all these moderators as they went through their outros. All right, so I'm going to pass it over to Credit Goddess. You're up next. Oh yeah, real quick, while Credit Goddess is coming to the mic, I can be reached at jarrett10k.com. That's JARRETT10k.com. And we'd love for you to follow me on Twitter, Instagram, Clubhouse, LinkedIn, as well as Facebook. All right, Credit Goddess, are you there? All right, she might have stepped away. There she is.
I'm actually on the consultation call, but really quickly, you guys can reach me at creditgoddess10k.com. That's creditgoddess10k, that's 10.com. If any of you guys are interested in building up your credit on your personal side and business side, and even if you're looking for lending, whether it's for startup or your current business to grow and scale, definitely tap in with me. It's preferred that you book a consultation because then we can dive deep into your credit situation and see how it can help if any of my services are best fit for you. So that's creditgoddess10k.com, or you can go to yourcreditgoddess.com and follow me on both Instagram and Facebook at Your Credit Goddess. Thank you.
All right, up next we got the Y CEO.
Hey everybody, I'm Tiffany, the Y CEO. So good to be here again. I am elated for everything that you have learned here today, and I am now an executive coach and mentor and also an advisor. I really love helping you live your best life and understand how to scale it in a way that makes sense. Most of my clients are executives transitioning from corporate to the private sector, so that's my specialty. I do a lot of leadership training as well. So you can connect with me at yceo10k.com and tap in. I'm very excited to help you in any way that I can. A lot of you have reached out to me already, especially on LinkedIn. And yes, I give free advice and I help guide you wherever you need to go to get the best information, because I do believe if you qualify what you need, then you can quantify it with the information that you obtain. It should be something that's actionable to help you get to where you're going. So I offer my services as often as you need them. I'm really just here to help the community. So thank you all so much. yceo10k.com.
Excellent, excellent, excellent. My name is Kirk Nugent. I get a chance to work with this awesome team to help broadcast this invaluable information to the masses. That's one of the things that live video can do for you, is to ensure that your information, your message gets out there. So if you want to, if that's something that you want to do, I know around this time of year, a lot of people are looking to start something new or learn from the mistakes of the past year. And one of those mistakes could be that while you have valuable information, you are not sharing it in the ways that people want to consume it. So if that's something that you're interested in, I know some of you have already reached out to me in different ways, but kirk10klive.com is where all my information is. You can book a session. We can do a discovery call. We can hear what your vision is, what you want to see from your live show. And it could be that you just need some training, right? You want to learn how to use StreamYard or Restream or Ecamm or any of these platforms to do it yourself. If you're a DIY streamer, no problem. We have a lot of resources for that. But if you are like Don, you're like, look, that's not my lane. I know exactly what value I want to provide. You want somebody to come alongside and produce your show. We have that service as well. So check me out, kirk10klive.com. Excited to be able to serve in this way. And again, the invaluable information that happens in this room, in these spaces, it would be a tragedy, truly, if you did not take right now and share it. Even after it's done, share it with your friends, family, loved ones. Grab the book, because this information is literally breaking chains and setting the captives free. Again, your boy Kirk Nugent, the Geek Speaker Preacher, kirk10klive.com. Thank you.
And just as Kurt just said, after you purchase the book, I just want to reiterate how you get your free 10K card, okay? Complimentary, because it's of so much value that I can't say that it's free. You want to go to ice10k.com and upload it to the link that says I'm ready, and build it out to your specifications, and let us know where to send the card. In under an hour or so, you will receive your 10K card value at $100. And I am Kenyatta. You can find me at kenyatta10k.com. And it's been a pleasure to help and serve and be here amongst this family. And we appreciate the presence. And we pray that we earn the privilege of your time. And you could connect with me on anything as far as locating great deals here in the great state of Illinois, soon Georgia, and to finance those deals as well. And as always, it's been a pleasure.
I am just super excited to be in the building with such incredible beings. Guys, make sure you take a screenshot of the stage. We're getting ready to wrap up for the day. And you want to be certain that you're following all of these incredible leaders on the stage and you're accessing them for every single room that they're in. All you have to do is punch their face, go directly to the left of that. You'll see a little bell. Click always on that bell. You will never find them in rooms that are not adding value in some way, shape, or form. And you want to be able to participate in those opportunities. I am your execution coach here in the state of Texas by way of Houston. We're getting ready to do a launch for 2022, the Soul Cleansing Reset. For those of you that want to really, really launch into 2022, have that mind right, get that heart right, and get yourself prepared for greatness. All of this information is not of value if you're not internally ready to receive it. You gotta get that inside worked on so you can manifest on the outside. This book is priceless. It's invaluable. It is a game changer. It's life transformative. It is an inheritance. Grab the book, even if you don't feel you need it. Grab it for a millennial. Believe me when I tell you, it can change the course and the trajectory of your entire family's future. Don't just think of you, think of tomorrow. We're not going to be here always, but your footprint can. This is Coach Coffee. I yield my mic.
All right, Chris, are you around to give a quick little outro?
Yes, yes. Thank you, Jared. Thank you, Don, and everybody else on the stage for bringing me up. Chris Monroe, real estate investor, serial entrepreneur out of St. Louis, Missouri. I teach you that you can buy real estate regardless of your credit score, regardless of your tax bracket, regardless of your circumstances with the proper knowledge and education. If you're interested in anything that is in my bio, which is loaded, check it out. Anything I can help you with, I'm here to help. Again, thanks again to the rest of everybody on the panel. Do what you do. Be who you be, and I'll see you before you see me.
Oh my God, Jared. I love it. That was hilarious.
I love it. And happy Clubhouse birthday, brother.
Thank you.
Yes.
Balloons popping.
Have mercy.
All right. And Don, one last thing I would love for you just to let people know.
Yes.
About the opportunity to meet you in person in Miami.
All right. So folks, if you see my avatar here, you see that I'm a sponsor. I'm a proud sponsor of Clubhouse Live. And we're going to be there in Miami. That's January 5 through 8. January 5 through 8. They're in Miami. Click on the link above our heads, and you can find the information for Clubhouse Live, the mastermind. Okay, so get that information, get your ticket, and we have a breakout room, and we want to see you in the place in our breakout room. And a lot of the people that you see here on the page, on the stage rather, they're going to be there with us. So you can meet us live. We can talk, we can chat. We're going to have some valuable information for you, and we're going to have some fabulous giveaways. So you want to have your face in the place so that we can make sure that we can connect face to face live right there at Clubhouse Live in Miami. Get your information from our 10K card right here. And click on that. Get the whole itinerary is there. The information about tickets is there. Let's get there. Let's meet up live. Thank you so very much, Jared.
Awesome. And the last thing I'd love for all of you to do is when you click ice10klive.com, you'll see Don's Facebook, LinkedIn, Twitter, and YouTube page. We'd love for you to follow him on all the platforms, subscribe, share, comment, like the posts. The more you do that, the more it will be visible to more people, and more people can be blessed with this information. And also, just make sure you share it with your friends and family, and check out the replays from the past. And you also have the option to forward those replays to folks that are not on Clubhouse, so they can get the benefit of the information in these rooms. All right, that's it for today. Everybody have a great week and a great Monday. And we're going to play the outro music, and feel free to follow anybody you haven't while the outro music get playing before you end the room. All right. Have a great day,
Remember,
everybody.
remember, folks, you want to like, follow, subscribe, and share, and click the notification bell. All
That's
right.
right. There we go. Take care, everybody.